The dollar is in crisis, isn't it?
Well, so our economic system is in crisis, and I'm really worried now that we're on the verge of a serious economic crisis that could see the destruction of trillions of dollars of additional wealth before this thing is over.
Yep. And then when you wrote the book, The Corruption of Capitalism, I mean, give me a break. Are we corrupt or what? Has it been corrupted?
So capitalism, in my view, became corrupted at the fundamental level when we stopped backing dollars with gold.
Yes.
And to make a long story, not too complicated story, but to make a long story short, this unleashed an explosion of credit. Credit absolutely exploded. Total credit or total debt in the United States grew from $1 trillion when I was 3 years old in 1964 to $91 trillion now. From $1 to $91 trillion in my lifetime. And during that process, that created a great deal of wealth, a great deal of economic growth in the United States and all around the world. But our economy became addicted to credit growth. Our economy must have credit growth to stay out of crisis. And now credit is contracting when you adjust it for inflation. So this is a very serious problem for our economic system, which I call creditism rather than capitalism.
But inflation, I'm afraid, is systemic now. And a lot of it is because what Richard's talking about is creditism. They just print so much money. Instead of solving the problems, they print money. And now it's going to backfire on everybody. Globalization
was extremely deflationary. It was pushing down prices and the inflation rate was very low, so interest rates were very low, so they could get away with printing a whole lot of money without causing high rates of inflation. Right. And by printing a lot of money, they would buy government bonds, and that would finance government spending and let the government spend a lot of money and stimulate the economy that way. So this was Goldilocks for 3.5 decades. But suddenly now globalization is going at least partially into reverse. Yep. First, we had COVID and the supply chain bottlenecks all around the world. Next thing you know, Russia's invaded Ukraine, pushing up energy prices, oil prices, gas prices, wheat prices, corn prices, another big round of inflation. And suddenly the central banks are in shock because for the first time in 35 years, they have to deal with inflation. And inflation in the UK is at 10%. It's 10% in Germany. It's practically 10% in the United States. And so now, if they try to support the economy by printing more money, that's going to just fan the inflationary flames. But if they don't print more money, then credit's going to contract and the economy is going to spiral into crisis.
Do you think about the BRICS, Brazil, Russia, India, China, South Africa? See, Americans can't see the BRICS. It's out of their picture. Brazil, Russia, India, China, South Africa, and the Belt and Road Project or the Silk Road Project. What do you think those guys are up to against the dollar?
So they used to all be very strong and moving together so they could be grouped together under this heading of the BRICS. But now they're all moving in different directions for different reasons. Russia's economy is in serious trouble because of its ill-advised invasion of Ukraine, and it's not doing very well. And they've got lots of sanctions imposed on them. They can't import any high-tech semiconductors, for instance, so they're going to run out of weapons. So their economy is in crisis. And of course, as you know, I believe that 20 years from now, oil's not going to have any value whatsoever. And their economy is entirely fueled by their earnings from oil and gas. So they're looking at a very dire future, in my opinion. China, they have the biggest bubble in history, probably, but since they have a totalitarian government that can make the banks continue lending and continuing to invest, their bubble will probably not collapse into any kind of Great Depression, but it is not at all inconceivable that they'll just stop growing the way Japan stopped growing 20 years ago. China's growth has driven the global economy since 2008 when the US stopped playing that role. And so no growth in China is a very big deal. India has better prospects because it's a little more friendly with the United States. And a lot of companies now realize that they'd probably better move their factories out of China which the United States is becoming increasingly hostile toward, and move it somewhere safer with a lot of low-cost labor like India. So India's prospects are the best among the BRICS, in my opinion.
Right. If China's in trouble and, Russia hit Ukraine, from an American's point of view, sitting in Thailand, what are the odds of China going after Taiwan? Your opinion.
It's a possibility, but probably
it's a possibility. It's a possibility. I'll be 6'5" next week, but
it probably won't happen because it would lead to a war between the United States and China, and at the very least, it would result in an economic calamity in China because China's trade surplus with the United States, the amount of goods China sells to the U.S. over and above the amount the U.S. sells to China, is more than $1 billion every day, more than $400 billion a year. So right away...
How much a day?
$1 billion a day.
That's the trade coming back and forth between China and America? China to America?
That's China's trade surplus. That's how much profit they make every day. More than $400 billion a year that they would lose overnight and never to recover if they invade Taiwan. So that's a very big incentive for them not to do it because unemployment would go up. It would cause social instability. They'd also end up having some of their cities wrecked, and the Communist Party might be overthrown.
So can Powell, Jay Powell, is the head of the Fed, U.S. Fed, can he stop inflation?
Well, he can if he increases interest rates high enough. And all hell broke out 2 weeks ago when Powell put out the Fed's new projections for how high they would increase interest rates. In June, they said that interest rates would be 3.4% at the end of this year. 3 months later, in September, 2 weeks ago, they said they're going to be not 3.4%, but 4.4%. And by the end of next year, he said they'll be 4.6%. So this was a radical adjustment upward in their projections for how high they're going to increase interest rates just over the next few months. And afterwards, that caused a big sell-off in the stock market. The dollar got a lot stronger. That caused problems for the UK pound, and all hell broke loose in the financial markets. And on top of that, not only are they hiking interest rates, but at the same time, they're reversing quantitative easing. Instead of creating money, they're now destroying $95 billion every month.
This is the U.S. Fed. This is the U.S. Fed's doing this.
That's right. The Fed is destroying $95 billion a month. Multiply that times 12 months, and that's going to be $1.1 trillion that don't exist 1 year from now, but exist today. That's about 13% of all the dollars, or destroying dollars like that. It's very likely that asset prices are going to keep falling because all of the asset prices are floating on this ocean of liquidity that the Fed is now draining. So it's like a bathtub. The bathtub is being drained of water and all the asset prices are going down. It's not going to stop until the Fed stops.
We could go on forever and ever and ever, and I've kind of led the agenda. Anything you'd like to say to the listener how to prepare for the crash? So
since the Fed is draining this liquidity on such an aggressive scale and hiking interest rates, the 30-year fixed mortgage rate is now moved up to 6.7%. All of the asset classes are likely to fall together. In the past, it didn't work like that. Stocks would go up and bonds would go down and vice versa. But today, they all move up and down together because they're all floating on this ocean of liquidity that the Fed is now draining. So as long as the Fed keeps draining liquidity through quantitative tightening, all of the asset classes are likely to fall together. Times like these are not times to look to make a great deal of money. This might be a good time to start thinking about improving your business, creating your own business, getting into business for yourself, something you can control, building up your own business, and worrying less about speculating in speculative assets in the hope that they'll go higher in the near term because they're probably going lower.
And how does quantitative tightening or stopping printing money affect bonds? Because bond markets are the biggest markets around.
Right. So if they just stop printing, then things would more or less be level. But they've not only stopped printing, but they're actually destroying money now. Instead of printing money, you can say they're unprinting money at the rate of $95 billion a month. And when they do that, what they do is they have these bonds that the government has issued. When they mature, the Fed takes the money from the government. And then the government has to get money from somewhere else, from the public. And that reduces the amount of money that exists in the economy. So with less money, that pushes up interest rates. That makes the bond prices go down and the interest rates, the bond yields go up. So quantitative tightening is another way of tightening monetary policy and pushing up interest rates and making it more expensive for people to borrow and consume or borrow and invest.
Right. 1971, Nixon took the dollar off the gold standard. 1944, during the Bretton Woods Agreement, the dollar became the reserve currency of the world, but we made a promise to the world that the U.S. dollar would be as good as gold. The trouble is, as Andy Schectman talks about in all this, is that we started fighting the war in Vietnam and the war on poverty in America, socialism. And we didn't have enough money. So we broke the Bretton Woods Agreement in 1971. Nixon took us off the gold standard, and that was the corruption of capitalism. They could print money rather than make work for money. So ladies and gentlemen, we're screwed.